Investment advisory services offered through Alpha Star Capital Management, LLC, an SEC-registered investment advisor. Alpha Star Capital Management, LLC, and SWAN-Capital are independent entities.
What your money would say. Andrew McNair. Money Talks. Are you listening? Money Talks. Are you listening? Money Talks. Are you listening? What your money would say with Andrew McNair.
We're live here on What Your Money Would Say. I'm your host, Andrew McNair. And for the next 30 minutes, every Saturday from 12:30 to 1 o'clock, we'll be taking financial chickens and making them financial swans. Because we believe on What Your Money Would Say and at SWAN-Capital, my wealth management firm, that as a retiree, you deserve to sleep well at night. And that's what SWAN stands for. And one of the topics that keeps many retirees up at night is long-term care expenses. And if you've ever experienced with an elder parent or a loved one, you know exactly what I'm talking about. It's devastating to see someone's nest egg deteriorate because they have to pay $2,500 to $4,500 or more for long-term care expenses, leaving their spouse ultimately destitute. But that doesn't have to be your financial future. That doesn't have to be your financial reality, because today you're listening to this show and we're going to share with you alternatives on how to take your financial future in your own hands. But you'll have to stay tuned because I have a few upcoming workshops that I want to share with you that are going on in this community. And by the way, the show is live. So if you have any questions throughout the show, call at 478-3116. That's 478-3116. So back to those community events. We have a Social Security class 101 at Pensacola State College that you don't want to miss. It's going on January 21st and 23rd at 6 to 7 o'clock. So it's a two-part class for 1 hour those 2 nights. And you don't want to miss it because we're going to share with retirees how to answer some very important questions. Like, will Social Security even be there for me? When should I take Social Security? 62, 66, or 70? Is my Social Security taxable? And if I choose to work while drawing Social Security, will I be penalized? Those are some important questions that you need to answer for your financial retirement. Now, another event that we have coming up is our Veteran Aid and Attendance Workshop. And you can sign up for both of those at swan-capital.com. That's swan-capital.com. Or call our office at 380-9558. That's 380-9558. Now, at the Veteran Aid and Attendance Workshop, we're going to share with families how to receive up to $24,000 a year from the VA. So if you're a veteran and want to receive up to $24,000 a year from the VA, you don't want to miss these two important dates. The first one is going to be January 13th at Sable House Assisted Living on 9 Mile Road, and January 14th at Broadview Assisted Living near West Florida Hospital on Davis Highway. And you can find out more information at swan-capital.com or call our office at 380-9558. And while you're on our website, sign up for our weekly market update so you can stay on top of the market, like us on Facebook, and follow our Twitter. Now, back to today's topic, long-term care expenses. As we've already talked about, it's just devastating to see many families come into my office and have spent down most of their nest egg that they've saved their entire life saving for just to be deteriorated in a few short years in a skilled nursing or assisted living. But there are alternatives. Now, you might have heard of long-term care insurance and are used to the traditional kind. I'm going to share with you some newer alternatives that can help protect your financial future from long-term care expenses. But I wanted to bring on an expert so I didn't mess it up, and that's Alicia Barnett, who's from Financial Independence Group, and she coaches financial advisors on what products to use with their clients. So, Alicia, welcome to the show.
Thank you so much, Andrew. Glad to be here.
Well, thanks for coming on, because this is a huge topic for seniors and baby boomers to be educated and make an informed decision on. And the price of health care is only continuing to escalate. What I've found is so many families are not prepared for how much it costs to be in assisted living or a skilled nursing. When it comes to the cost of healthcare, is it increasing that CPI at 3 to 4%, or is it increasing higher, Alicia?
Well, Andrew, nationally, long-term care services are actually increasing about 5 to 8% per year.
5 to 8% a year, and that's way more than what we've been quoted and told that CPI, the Consumer Price Index, costs only increase 3 to 4%. But when you get to retirement, it seems like the CPI doesn't apply to us. It doesn't apply to your own personal economy. In reality, when you get to retirement, travel expenses are going up every year. Health insurance premiums are going up, and also your long-term care insurance prices are going up. So you have to be prepared for more than just a 3 to 4%. You got to be prepared for an inflation rate closer to 5 to 8. And in Pensacola, the average assisted living rate that I see is about $2,500 to $4,500. So a lot of times when families, wake up from that sticker shock and wake up from the shock of the prices, they say, well, Andrew, how do I get protected? And who's going to pay for this expense? I mean, who can afford $2,500 to $4,500 a month? And that's not talking about a skilled nursing that's over $6,000. Who's going to pay the cost, Alicia? Is Obama going to save me?
Well, Andrew, it's funny that you say that. Actually, Obamacare or Obama is not going to cover long-term care expenses. They did at one point have a long-term care provision in Obamacare called the Class Act, but it was repealed starting in 2011. So there will be no government long-term care plan. Right now, the way that people are paying for long-term care expenses are self-pay. You've got Medicare, which covers a very small portion, only nursing home. Medicaid, which is basically you have to spend down your assets, and it's for the poor. And then you have long-term care insurance plans. And that's pretty much the four types of pay for long-term care services.
If you're just tuning in to What Your Money Would Say, Alicia's explaining that your only option is private pay when it comes to assisted living. 98% of the time, you are going to be the sole responsible person for the security of your financial plan when it gets into long-term care expenses. Medicare's not going to save you. Medicaid's not going to come in and save you. And Obamacare doesn't cover long-term care expenses. So you have to make sure that you're protected. And one of the ways to do that is long-term care insurance. And there's two types of long-term care insurance. One that many families are familiar with, and the other that they're not so familiar with. And I want Alicia to kind of explain the two sides. Alicia, what's the two kinds of long-term care insurance?
Absolutely, Andrew. There are two types. There's premium pay, which is considered traditional long-term care insurance, and asset-based long-term care insurance. Traditional long-term care provides long-term care benefits if you need it. It's not like your life insurance or annuities that builds cash value. The premium is less expensive than your asset-based long-term care. It's written only on individual lives. There's no death benefit, and there are limited benefits, usually a pool of money from which claim is drawn from a specified amount. Your payment options are basically you pay them for life, like you do your car insurance or your health insurance until you need them. They are guaranteed renewable. Basically, that means the policy is guaranteed to be renewed as long as you pay the premiums on time. The benefits nor the premium are guaranteed, so unfortunately those premiums can go up.
Which a lot of people have seen. A lot of people have seen on traditional long-term care, premium doesn't always stay the same. It's been increasing for a lot of families because they didn't price it back right in the 80s. So it's guaranteed renewable, but doesn't mean that the premiums aren't going to go higher. The asset-based, what's the difference between the premium pay and then the asset-based?
The asset-based, Andrew, basically provides long-term care benefits if you need it. But the good news is it builds cash value. Initially, the premium is more expensive than traditional long-term care. It's written on individual lives as well as joint lives. There is a death benefit, so it returns the premium invested magnified by a multiplier if no care is needed, or it returns the death benefit less any claims. So if you don't use it, you don't lose it. There is that asset there if you don't need it. The benefits can continue for lifetime of the insured. So whereas on the traditional policies, you used to have lifetime benefits, so benefit would last forever, that's no longer available. But on the asset-based long-term care, there is a product out there or products out there that will give you a lifetime benefit. The premiums can be paid either continuous pay, like your traditional, but the premiums are guaranteed never to go up. They can be paid single premium, 10 pay, 15 pay. Depending on the product, there's features that allow those benefits to be paid up if chosen. Again, Non-cancelable, which means as long as the premiums are paid on time, the premiums and benefits are guaranteed to stay the same on these. So again, those premiums will not increase. These products were created in the late 1980s. They're a little harder to understand since most people aren't familiar with them, so I like to kind of simplify it by saying they have three provisions: a live provision, a quit provision, and a die provision. If you live and need long-term care, the insured has access to the benefits for long-term care. If you die and don't need long-term care, you've got a death benefit, and you've got a quit provision. If you decide you want to surrender the policy, you've got a value at any point in time, or some products even have a full return of premium.
Wow.
So again, to simplify it, live, die, quit. You've got benefit for every type of need.
Scenario. That's neat.
Every type of scenario.
And we've seen over the last 20 years, long-term care insurance has evolved. Most families are so familiar with the premium pay, the traditional long-term care insurance, and not so familiar with the asset-based long-term care insurance. So if you're just tuning in to What Your Money Would Say, we're talking about the two kinds of long-term care insurance, and we're going to talk in detail about the asset-based kind because it is where the market of long-term care insurance is going, and it's a lot newer, and sometimes it has a lot more better features than the traditional long-term care does. If you say, Andrew, all this is super complicated, I don't know if me and my family are protected, I want to just talk to a real person. Well, we're going to encourage you to schedule your 1 hour free long-term care insurance preparation assessment, where you sit down with me for 1 hour and we talk about your potential individual care needs to make sure that if you already have a long-term care insurance policy or that if you don't, you're protected and your family's protected from eating away your assets inside of an assisted living or skilled nursing, and ultimately leaving a legacy for your family. So if you want to sign up for that 1 hour free long-term care preparation assessment, call our office at 850-380-9558. That's 380-9558. The asset-based long-term care insurance, I like to explain it, kind of like taking the money from your left hand and putting it in your right hand. Many families have money that's just sitting idle in CDs, what I call GBS accounts, going broke safely. We're sitting there making barely 1%. But when we get to long-term care insurance, we're hoping that long-term care expenses, we're hoping that we can self-insure, but we've never seen that the cost, it typically averages around $2,500 to $4,500. So we can eat away that $100,000 in CD money very quickly. But the asset-based long-term care insurance gives us the opportunity to take $100,000 and turn it into $300,000 if we ever need it for long-term care insurance and spend that money tax-free. But if we never get ill and we just pass away, like I'm planning on doing in my bed if I can have any control over it, that money can go to my heirs. And she talked about those three provisions. Alicia, will you say that live, die, quit provision real quick about the asset-based?
Absolutely, Andrew. Again, the asset-based product, and I like to call it owning your policy versus renting it. On your asset-based product, it has the three provisions. If you live and need long-term care, it's got a long-term care benefit. If you die and don't need a long-term care benefit, it gives you a death benefit. And then you've got your quit provision. If you decide to walk away, you have the surrender value or, depending on the product, your full return of premium. So, again, you've got three provisions for three different scenarios.
That's really reassuring for a lot of families that only know about traditional long-term care insurance. They only know about the kind where you can pay $3,000, $4,000, $5,000, and if you don't use it, you lose it. And that doesn't sound like a good deal to me. It's kind of like home insurance. You hope your house never blows away, so you have to pay this home insurance company all this premium every year, hoping your house doesn't blow away, but if they do, they'll replace it. Well, that doesn't sound like any way to live. I like the asset-based long-term care insurance where you can take your money, take it from an asset that's not making any money in a bank and take it to another bank that earns the equivalent returns, but gives you the chance and the peace of mind knowing that if you ever need long-term care, that you have a pool of money that's way larger than you ever had before in the bank. So it's a huge, great opportunity for families that are looking to protect their nest egg from long-term care expenses. So if you're just tuning into What Your Money Would Say, I have Alicia Barnett, who coaches financial advisors on what long-term care products are right for their clients. So she's a real expert in this long-term care insurance field. And we're encouraging families to sign up for their free 1-hour long-term care preparation assessment, where we'll find out exactly what you own if you already own a long-term care insurance policy, help educate you on your policy probably more than you ever understood it before, and make sure that your individual care needs line up with what you own. And if you're trying to self-insure, making sure that you have enough money set aside for those long-term care expenses. Now, if you're owning a long-term care policy and you say, Andrew, I have this thing in my drawer in my safety deposit box, but I don't understand it at all. Well, I hope that you're pulling that thing out, because we're going to talk about some very important terms that you need to understand before you get there in assisted living or skilled nursing. And one of those terms is the daily benefit. Alicia, can you talk about the daily benefit term and why that's so important to make sure it lines up with what potentially you could be paying?
Absolutely, Andrew. The daily benefit, Andrew, is how much your policy will pay per day for long-term care services. Most long-term care policies are reimbursement policies, so you're basically reimbursed for expenses up to a daily benefit amount, which is determined when you first purchase your policy. So, for example, if you have a $100 a day benefit, you can get up to $100, but not more than that $100 for your long-term care expenses.
And that's important that you get that right, because if you have a $100 daily benefit, but you're going to pay $150 a day in assisted living or $200 or more a day in a skilled nursing, you're going to have to come out of pocket that $50 to $100 a day difference. And I hope your pockets are deep when it comes to these expenses, because they can rack up pretty quickly when it's on a daily benefit amount. Now, let's talk about the benefit maximum you kind of alluded to. What's a benefit maximum? They don't pay my long-term care insurance expenses forever?
Andrew, I wish they did. They used to back in the early 80s and 90s. However, things have changed. Now most of the policies have what's called a benefit maximum. It's an amount of money or days of care beyond which a long-term care policy will no longer pay benefits. And basically how they determine that is by your benefit period, which is the number of years that you choose on a policy. For example, 2 years, 4 years, 5 years, 8 years. So they used to have unlimited policies, but that's no longer available on the traditional long-term care pay-as-you-go policy. So benefit period is nothing more than a multiplier, and what that does is it gives you a pool of money based on how much your daily benefit is. For example, if you've got a $100 a day benefit, you've got a 3-year benefit period. If you multiply that $100 out by, of course, 3 years, it's going to give you a pool of money or a benefit maximum of $109,500. So I like to call it a long-term care bank account. You can draw up to your daily benefit, so up to that $100 until that $109,500 is gone.
That makes total sense. So if you have a long-term care insurance policy, I hope you're listening to help you understand what the daily benefit and the benefit maximum is. And the benefit maximum is an important term that you need to understand, because if your policy has $100,000, and like Alicia said, that's your bank account, your long-term care bank account. But if that bank account runs out, kind of like when mine did in college, you're in trouble when it comes to long-term care expenses, because then you're on the hook for those long-term care expenses. So that's why I encourage you to sign up for your long-term care preparation assessment. It's a free 1-hour meeting, no obligations, nothing. I'm not going to try to sell you anything. And we sit down and we say, here's your policy. Here's what current expenses are going to cost. Are you protected? Are you making sure that your family is protected from spending down all your assets inside of assisted living? You might say, well, Andrew, I have $250,000, $500,000 set aside for these costs. That'll take care of me if the long-term care insurance runs out. Well, I don't know about you, but I don't want to make an extra donation to the assisted living unless I have to. So you want to make sure that you have the proper protection. Again, like having a car insurance, and it protects your maybe a $10,000 car, but you have a $25,000 car. You're paying for insurance, but you don't know if it adequately covers how much you need to protect. So that's why I encourage you to sign up for that preparation assessment. Call our office at 850-380-9558. That's 380-9558. I want to give someone another example of how the asset-based long-term care insurance product really works. And here's a great example. As a couple, we have Bill and Carolyn. It's a husband and wife, 65 and 62. They had $250,000 invested, mostly in CDs and bonds, very conservative. Maybe let's just peel off $100,000. You know, we're only making 1% at the bank with that $100,000. Let's go make the same percentage. But here's the great kicker. If Bill got early onset Alzheimer's and he has an income of $3,000, him and his wife combined, and now he goes into assisted living to help assist him with his Alzheimer's, and it's $3,500 a month. As you know, the mortgage payment, all the other expenses for his wife, Carolyn, don't cease. They don't end. So now he's paying that $3,500 to the community. That $100,000 that he peeled away, he pre-planned, and he bought this asset-based long-term care insurance, and that $100,000 turned into $300,000 tax-free pool of money that he can spend to make sure that him and his wife don't go broke in assisted living or a nursing home. So if you want to find out more information about that asset-based long-term care insurance, call SWAN-Capital at 380-9558. That's 380-9558. Back to families that already have a policy and trying to understand it. What's another term, Alicia, that some families need to know about?
Andrew, I think a big one is the elimination or the waiting period.
Oh, yeah.
That basically determines when your policy starts. So you have a daily benefit. So how much of a benefit are you going to get?
You mean they're not going to pay me immediately when I get in a long-term care situation, a long-term care bind? They're not just going to start paying me immediately my own money?
Absolutely not. You've got that elimination period, which can range anywhere from 30 days to a whole year, typically on average 90 days, that you have to pay out of your pocket before your benefits will start to pay on your insurance policy.
Wow. I mean, here's a good analogy. That's like having car insurance and having a car that gets wrecked and you have to wait 3 months before the insurance company can get you a new ride to drive in. Well, the same thing is for long-term care insurance. If you get an assisted living, you're going to have to wait 90 days and pay out of your pocket. So you need to make sure that you can pay that. So I would have at least a year ready to pay for those expenses in case the long-term care insurance company drags their feet. So thank you for explaining the elimination period. What about that inflation rider that are in some long-term care policies? Is that important to have?
It is important to have, and unfortunately a lot of policies have been designed without it. But what the inflation protection does is essentially it's a feature that allows the daily benefit in the pool of money to grow based on a selected interest rate. For example, you can do 3% compound inflation or 5% compound inflation. And basically what that does is it increases, again, both your daily benefit and that long-term care bank account to grow over time. Because most people, if I were to buy a policy today, I'm going to assume that it's not going to happen to me tomorrow. So it might be 10, 15, 20 years before I use it. And as we all know, based on the current inflation for health care between 5 and 8%, it's going to be a lot more tomorrow than it is today.
And that's a nice thing to have when you get 20 years out and that $2,500 to $4,500 expense is now $4,500 to $7,500. It's nice to know that your long-term care insurance is going to line up with what the current expenses are when you get there. And the only way to do that is to sit down with a calculator or sign up for our free 1-hour long-term care preparation assessment with me for 1 hour, and we determine if your current long-term care insurance is enough to protect you and your spouse in case you ever get in a long-term care situation. So if you're out there and you want to schedule that long-term care insurance assessment, call SWAN-Capital at 380-9558. That's 380-9558. Now, if you're saying, again, Andrew, that traditional long-term care insurance is not for me, I want to know a little bit more about that asset-based long-term care insurance. Well, again, it's like taking your money that's just sitting idle in your GBS account, your CD account. I call it GBS accounts because it's like going broke safely. And we take it from earning just a 1% to earn a CD equivalent. But if you ever need that money, that $100,000 that you invested turns into $300,000 that you can use tax-free for long-term care expenses. Alicia, if you'll highlight one more time that Live die and quit provisions of the asset-based long-term care insurance?
Absolutely. We've got, I like to keep it simple, and with the asset-based products, again, it's owning your policy versus renting it. If you don't ever use it, you still have your asset. So basically, if you live and need long-term care, you have a long-term care benefit. If you die and don't need long-term care, you have a death benefit. If you choose to quit, you can get the guaranteed surrender value at any point in time, or with some products out there, you can get the full return of premium, so you could get that $100,000 back.
Wow, that's huge. So again, I want to thank Alicia for coming on the show and sharing with us insights about long-term care insurance and long-term care insurance expenses. Thanks for coming on the show.
Absolutely. Thanks so much for having me.
Today's financial landscape can be rough. One of the most important aspects of planning is choosing the right guide to help you navigate the road to retirement. Andrew McNair and the team at SWAN-Capital is dedicated to providing the very best service in the retirement planning industry today. SWAN-Capital is a full-service independent wealth management firm dedicated to providing guaranteed custom income plans that you cannot outlive. Contact Andrew McNair at SWAN-Capital 850-380-9558. That's 850-380-9558. The difference between SWAN-Capital and you retire once. We help people retire every day. You should be enjoying your retirement years, not letting worry keep you up at night. SWAN-Capital. Sleep well at night. Contact Andrew McNair at SWAN-Capital 850-380-9558. That's 850-380-9558. Again, that's 850-380-9558.
Welcome back to What Your Money Would Say. I hope you enjoyed that conversation with Alicia Barnett, where we talked about the different kinds of long-term care insurance. That being the premium pay, the traditional long-term care insurance that most families are used to. And then we also talked about the newer kind, the asset-based long-term care insurance, where you can literally take $100,000 that's earning maybe 1% in a CD and take it and put it in your right hand, where it's earning a little over the same CD equivalent rates. But if that money is ever needed for long-term care insurance, they'll times it by 3, so that $100,000 turns into $300,000 tax-free. So it's a huge opportunity. If you want to find out any more information, call our office at 380-9558 or check us out on the web at swan-capital.com. Now, I want to share with you a few community events if you're just tuning in. We have our Social Security Class 101 at Pensacola State College coming up January 21st and 23rd. The tuition is about $20+, so you want to get signed up now. And we're going to talk about some very important questions and answer those for retirees, like such as, will Social Security be there for me? When should I take Social Security? 62, 66, or 70? Or is my benefit taxable? And if I choose to work, am I still going to get penalized? Those are some important questions that if you need some answers to, you don't want to miss the Social Security Workshop at Pensacola State College. And you can get registered at swan-capital.com or call our office at 380-9558. And also, if you're a veteran and you're over age 65, you don't want to miss our Veteran Aid in Attendance Workshop, where we share with families how to receive up to $24,000 a year. That's right, $24,000 a year from the VA, from a program that's been around since 1951. So you don't want to miss that workshop at Sable House on the 13th and Broadview Assisted Living on the 14th. Check it out at swan-capital.com, and I look forward to seeing you next time on What Your Money Would Say.
That's good. You got to stop plenty of time there.